Right, I think we've got everybody in now. Okay, so good afternoon, everyone. Thank you for taking the time out of your busy schedules to join our webinar today as we discuss pension considerations for Americans in the UK. So our presentation will begin shortly. I'll be the moderator of the webinar alongside our panel of guest speakers, who I'll be introducing here in a second, which includes Martin O'Grady and Gillian Everall. So as an introduction, Martin is co-founder and partner at an independent financial advisory business called Riverside Financial Solutions. He is a results-driven financial advisor with over 16 years experience in top-tier wealth management firms, looking after high net worth individuals and their families. And as for Gillian, Gillian's expertise in advising high net worth individuals began when she trained with Deloitte and gained further experience as she worked with some of London's top accountancy firms before moving on to become an associate director at Frank Hirth PLC in the private client group, where she developed her knowledge particularly of the issues facing US citizens living in the UK around their pensions and investments. So we will be putting everyone on mute as soon as the presentation begins, but please feel free to ask any questions in the chat and we'll do our best to answer them for you or interrupt the speakers to get their thoughts. And just before we start, last thing, a few disclaimers to go through for compliance, so just bear with me. So information presented is for educational purposes only and does not intend to make an offer, solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. So I'll let our speakers take it away.
Brilliant. Thank you so much, Bailey. And thank you, Gillian and Martin, for joining us today and everybody else joining us today. We'll make this as dynamic as possible. So please, just interrupt, get involved, and we'll try to make this as conversational and fun as possible. Right off the bat, though, let's just take Martin and jump into what are all these acronyms and such for all these different retirement vehicles here in the UK. We hear SIPs, we hear pensions, we hear defined benefits, et cetera, et cetera. Can you take us through those?
Yes. So first of all, thank you, first of all, Brian, for the invite today. And good afternoon, everybody. So yeah, probably within the financial services industry, in fact, we like plenty of jargon and acronyms. But so yeah, two types of pensions we'd have is defined benefit or final salary schemes and contributory pensions. The latter, contributory pensions, they are more the norm nowadays, and defined benefit pensions are not so frequent, if you like. With regards to, I suppose, if we go into the pensions nowadays and the acronyms, you've got things like SIPs, which is a self-invested personal pension. You've got a QROPS, you may have heard of, it's qualified, recognized overseas pension scheme. And there are quite a few others, but hopefully after today, we'll have go some way to maybe making things a little clearer as to what these are.
Perfect. Now, in these pension vehicles, and I'll address this to both of you if you don't mind, are there restrictions of what you're allowed to own inside of a pension or a SIP, especially for us Americans?
Yes, so Brian, so what we'll typically have, a SIP is a type of personal pension, one that affords you a little bit more flexibility insofar as what you can invest in there. For example, within a SIP, you can have commercial real estate, and that's very specifically commercial, not residential. Also with SIPs, you can often leverage up to 50%, but ultimately it's really a bit more flexibility. So when we speak with clients and ascertaining whether it's a personal pension or a SIP, it's very much driven by what their objectives are, what they're trying to achieve. Often a SIP will be more expensive. So if it's not a necessity, we'll often just go with a personal pension.
Perfect.
From a tax perspective, the really nice thing about pensions is the fact that you don't have to worry about some of the normal issues that we talk about all the time, and everyone's probably heard to death when you're talking about investments held by US citizens resident in the UK. And that's, you don't have to worry about PFICs, you don't have to worry about whether things are tax advantaged on both sides of the Atlantic, because thanks to the double taxation agreement, and specifically the way that's worded, it's absolutely clear that what goes on inside of the pension is not exposed to tax in either jurisdiction. So a US pension scheme, we don't worry about what goes on inside that here, and vice versa. Whatever you have within the SIP is tax protected because the wrapper is protected and very much sort of set out in the double taxation agreement, so everyone knows where they stand.
I think you universally just made everybody on this call smile with just that vantage point. So I'm going to double down and ask you the follow-up question, Gillian. What about the FBAR reporting? Do we need to make an FBAR reporting for our UK pensions?
Yeah, categorically, yes. Particularly SIPs, much less so employer-backed pension arrangements, but a SIP categorically, yes, that falls within the category of being needed to be declared on the 8938 or on the FBAR. So reporting, absolutely, get it on there, note the value, etc. But just be comfortable that there's no nasty tax consequences that'll come back and bite you later down the line.
Beautiful, beautiful. And for any of you that are listening to this and PFIX and FBAR sounds like a bunch of jargon, just go to our YouTube station, our YouTube channel, Dunhill Financial. We'll send you the link there afterwards, and we'll also send you a copy of our American Expat Guide. And there's plenty of information that will go through exactly how those work. But the good news is not having to worry about those PFICs. Now,
sorry, Brian, we've just had a really sort of great follow-up question, which I didn't cover, which is the perennial, do we need to do 3520 and 3520A reporting for a SIP? AKA for everyone else, is it a trust from a US tax perspective, or is it not? The short answer is you'll get different, unfortunately, you'll get slightly different views, potentially depending on who you speak to, because the answer isn't crystal clear. The vast majority of practitioners here now in the US UK space are of the view that it's not wanted or required by the IRS, but they themselves haven't categorically made that clear. If people have heard of or are aware of the regulations that came out, I think it was early last year, it isn't specific enough on SIPs per se. It does cover certain types of pension not being within this reporting category. It doesn't give clarity on SIPs, but it's generally felt it's enough of an indication of the IRS's viewpoint that they don't really want these forms for pensions, but there is obviously still a modicum of risk involved, but it's felt increasingly that that's a minimal risk, and probably on balance most people say no.
I like it. Now, are there certain contribution limits of what you're allowed to put into a pension on an annual basis, Martin?
Yeah, so we have what's called an annual allowance, Brian, which is maximum funding of £40,000 per tax year per individual, and that is determined by earnings. In other words, you can't fund beyond your earnings if your earnings are below that threshold. That also links with another parameter or threshold, which is a lifetime allowance. So over the course of one's lifetime, they have an amount, and this can qualify across a number of pensions, whereby they can ideally not fund above the lifetime allowance, which currently is £1,073,100. But if they were to do so, it can be rather punitive from a tax point of view, which can be really, I suppose, non-productive from what we're, certainly as financial planners, what we aim to achieve. They're the kind of things, again, that we would advise clients about and ensure they're within those parameters and manage that for them.
What if we missed last year? Are we allowed to do a little extra?
Yeah, so with pensions, which is it's really good, you can actually back fund for up to 3 years. So if you've overfunded in 1 year, you can use any allowances unused from up to the previous 3 years. Again, driven by earnings as to how much you can do that. But yes, so again, it's good flexibility.
Brilliant. And then with these distributions, how do those work from a tax perspective, Gillian?
Distributions from a pension scheme, Brian?
Yeah.
Oh, my favorite topic. So first of all, if I can just quickly address a follow-up question that's appeared on the chat, otherwise I will forget. I'm getting on in years and I'm struggling with short-term memory. No, I'm only joking. But essentially, I've been question in the chat is, does lifetime allowance include US pensions? And to piggyback on Martin's very helpful explanation on tax limits here and contribution limits, the short answer is only US pensions only contribute to your lifetime allowance if you've claimed UK tax relief. So if those pension contributions, if you've been making pension contributions to your US scheme whilst a UK resident and noting, as you are entitled to do on your UK tax return, that they're qualifying pension contributions in accordance with the treaty and you get tax relief on them, subject to, as Martin says, earnings limits and your general allowance, annual allowance of pension contributions each year, then the pension fund relating to those contributions on which you've had UK tax relief does count towards your lifetime allowance. So moving on now, if I may, to your question, Brian, which is how are distributions taxed? Well, the short answer is income distribution, so your normal annual pension income, is taxed in your state of residence. So for those that are living here, regardless of whether it's a UK pension or a US pension, it gets taxed here. It's part of your annual income and taxed to UK tax accordingly. From a US tax perspective, it is reportable, but you get, regardless again of whether it's a US pension or a UK pension, you get to claim recognition in the US for the tax paid on the same amount in the UK, so that you don't get doubly taxed. So that's the slightly easier part of things, which is the annual income distribution. Addressing the elephant in the room and trying to take a great big bite out of it. A question we also always get asked is, what about the 25% tax-free lump sum? And I know you well enough, Brian, to know if I hadn't gone there, you'd have taken me down that road.
It's the next question on the list, so.
That's the nice thing about knowing each other. So yeah, if we get that one out of the way, increasingly, I think people are now comfortable that the 25% tax-free lump sum does get recognition on both sides of the Atlantic. So not only is it tax-free here, but by virtue of the double taxation agreement, the clear intent is that it's tax-free in the United States as well. And again, while we have the great fun and games that is tax law, of it not being absolutely crystal clear and technically capable of interpretation, it's been something that practitioners here, they've been recognizing the 25% as tax-free in the United States for many, many years, many years. And I'm not aware, as of the date of talking to you today, of any occasion of the IRS challenging it. So I think even if there's a question mark over the strict wording, we can get comfortable with IRS practice being that this is something they feel is correct. So the 25% tax-free lump sum, I think, again, the majority of practitioners here would treat that as tax-free. Lump sum distributions generally, so if for whatever reason someone chose to collapse their entire pension scheme and have that paid out to them, which particularly in the UK they're entitled to do, then that does go back to where the pension scheme is located. So in the case of a UK pension, the tax position would be that that's taxable under UK law. But in accordance with the double taxation agreement, there are no implications from a US standpoint.
Now, just to clarify, you're saying the 25% ruling doesn't get identified by the IRS when an American's resident here in the UK. If the American is back in the US, would it be different?
No.
Brilliant.
No. The feeling for a number of years when I was slightly younger in my days in this space was that, in fact, it was more clear-cut in that instance. And the ambivalence was if an individual was resident here at the time of drawing down their 25% tax-free lump sum, just because of the way it was worded. So if you were taking it physically in the US and physically US resident, that was fine, but there was a question mark for a number of years over whether you could receive the same benefit if you were resident in the UK at the time. And everyone seems a lot more comfortable these days that yes.
You know, there's not so many times that you can say a tax accountant on a webinar has made everybody smile twice in a row. So now, Martin, we've got to play catch up from the financial planning standpoint, and we've got to dig in. And sadly, I've got a loaded question there for Martin. In the US, when we transfer 401ks over to IRAs based on a 2005 ruling, it's quite a simple process. Moving one to another, whether we move it from a 401k to an IRA or a simple to a SEP, it's a really easy process. What's the process look like over here of consolidating our SIPs or our different pensions?
Well, since April 2016, I believe, when we had the pension freedoms come in the UK, that activity in people choosing to consolidate pensions, transfer pensions from one place to another, has grown probably exponentially year on year, Brian. And in fact, it's very easy. It's probably probably our highest volume business today. But you know, if I was to describe the process, we've got somebody who's maybe had 3 or 4 previous roles. We're about to put in place a financial plan for them. We'll prepare letters of authority for them to sign, and we will go to the different providers on their behalf and collate that information for them, and then present what we think is the best solution for them. As I mentioned earlier, whether that's a SIP or a personal pension, it will be driven on a case-by-case basis. Probably one of the other things worth mentioning that Gillian has spoken about already, but the lifetime allowance here in the UK, that's actually being fixed until April 26. So that's actually given some people some comfort, because there have been questions probably before the last budget about various taxes. Gillian will know a lot more about it, but yeah, so I think we're looking at potential just year-on-year inflationary rises, but other than that, it being fixed.
So there's a few key reasons why we should be looking at changing our pensions. Some of them might be estate planning related. This can be very helpful when you have a defined benefit scheme and you're wanting to move over into a SIP. Other reasons might be a currency a currency reason. If you have your typical UK pension, you're probably in a natural currency hedge towards pounds, i.e. you have more than 3% allocation in GBP. If you're going to retire to the United States, it might be more advantageous to have a more US dollar underlying set of funds inside of there. So currency purposes are going to be important when considering where your pension is. And sometimes you just want to have the ability to manage the underlying assets inside of there. Now, that's to where we have plenty of webinars where we show how we manage assets and how we can do those types of things differently. But right now we have the expertise of Martin and Gillian. So I'm going to concentrate on these aspects that I really like to dive into with them. And with all the jargon we've thrown out there at you, Martin, can we go into your thoughts on QROPs for Americans versus SIPs?
Yes, so QROPs, albeit we're probably seeing less and less of them, if I'm honest. But as I said earlier, they're essentially, they are qualifying, recognized overseas pension schemes. One of the things we would always look at is there are very few qualifying schemes. So when we're tentatively looking, is a SIP a solution or is a QROPs? One of the things with QROPs, you will have a withholding tax, which I'm sure Gillian probably can elaborate on further. But that's one of the things for certain people. And another thing is, where will they ultimately end up, and how will that jurisdiction look on it from a tax point of view? As I said, one of the things I've noticed as well is if for any reason a QROPs scheme is not deemed by the HMRC to be bona fide, if you like, there can be severe tax implications. And again, it's one for Gillian. So yeah, as I said, we're probably seeing less and less instances of QROPs. But yes, it's certainly for international residents in the UK. That's something that we'll always consider.
And I can only echo a lot of what Martin said. Where we see them work best is where, well, I guess two key parameters. One, the individual is comfortable not taking income from the QROPs within a 10-year period, because the reporting and the tax position of drawdown within that 10-year period is not really any different to if they'd remained in a UK pension scheme. So really, to obtain any benefit of a transfer out to a QROPs, you have to be thinking of that kind of time period. And clearly, again, if you're going to be resident in the UK, as I've already highlighted, you're going to get taxed on that pension anyway. So actually, why would you be considering a QROP versus something like a SIP if you were retiring in the UK? So it's best placed to serve someone whose intention is to retire outside of the UK. They're not really planning on taking the distributions from the fund within a 10-year plus time frame, and they're looking for that greater flexibility and lack of restriction. As Martin highlighted, even in a SIP, you can't own residential property. So there has to be a number of things indicated before a QROPs becomes something that's considered. Another interesting point for those who are building up a more substantial pension pot is it is measured against your lifetime allowance. So when you take a UK pension fund that's in excess of the just under 1.1 million that Martin's indicated, and you've got something, you're transferring a fund that's more than that, you're incurring, or you're certainly running a strong risk of incurring a 55% tax charge on that differential as a result of considering a QROPs transfer. So they have a place, but the circumstances have to be right.
very well summarized right there at the end. You know, for most situations, it's not going to be the solution. It's only going to be for those small ones in the periphery. We've got a couple questions that have come in that are great questions, and so I'm going to dive into those. This one I think is more for Gillian. Does the UK take care if you transfer your US IRA to a 401k or 401k to an IRA? Is it simple in UK reporting what one has done with their US accounts?
Yes, in short, US pension to US pension, because it is an exempt transfer from a US perspective. So as long as it's a qualifying exempt transfer from a US perspective, yes, again, that is recognised under the double taxation agreement. We would normally note the transaction in the additional information area of the return and highlight the fact that this is something that's covered by the double taxation agreement, and highlight the relevant article of the agreement that we're basing that on, but nothing more than that.
I think the only time that there's a little bit of an exception is with TSBs for government employees that have been dignitaries and such. Yeah. And that's one of those. Then there's those different little parameters. But yeah, our typical 401k to IRA, we really like doing those. If you have an individual that's going to retire here in the UK, you don't have to worry about what's inside of your IRA, because you don't have to worry about those HMRC guidelines for getting the lower tax rate. But we've gone 4 years of the dollar going up compared to the pound going down. Now, all of a sudden, the pound's starting to come up again. And so if you're going to retire here in the UK, getting your money into a vehicle like an IRA, where you have more ability to buy a higher denomination of pounds so that we naturally hedge to the pound, is going to be advantageous to you in minimizing that currency risk over the course of time. Like I said, we have plenty of material on that, or come back to us with any of those questions. This becomes a perfect lead-in question to, can we ever cross borders? Can we ever move IRAs or the such over into SIPs, or SIPs over into IRAs?
Do you want me to? I can take that one.
Love it.
It depends. They are not automatically exempt transfers by virtue of the double taxation agreement, because they are not covered specifically in the wording of the agreement. It's not as straightforward as UK to UK pension rollover or US to US pension rollover. So it depends very much on the circumstances. So it depends on foreign tax credit carryover capacity that an individual has. It is possible as an option for someone who's happy to use up some surplus foreign tax credits that they have from a US perspective. It is also an option for someone where we can find a scheme. If we were talking US to UK, UK to US, we would want that US receiving scheme to be a cure-up, because we would want that to be an exempt transfer from a UK perspective. But US to UK, it is technically for tax regarded as a distribution, a taxable distribution of the fund. So we would want to have a look at the foreign tax credit position and whether overall it's going to achieve tax efficiency for that person.
Brilliant. Which leads into this next question that we have. Do employer pension contributions need to be reported on your US tax return? Can they be excluded using the foreign earned income exclusion?
Yes, and yes. Yes, they need to be reported, but yes, they can be covered by the foreign earned income exclusion.
And sometimes you would want to use the credit system instead of the FEIU.
You then, absolutely, Brian, you then would do your normal exercise of looking at whether it's right for that person to use the foreign earned income exclusion, or whether they want to be looking at a foreign tax credit basis of reporting, which means that if the UK tax paid on that salary is more than the US equivalent tax that's due on those amounts, including the employer contributions, which obviously, just for the avoidance of doubt, aren't taxable from a UK point of view. So that's one area of difference. They can actually have the surplus banked against future income that they might have, which would otherwise attract a potential US tax charge. So that it would be a normal thing for a US UK tax advisor to make an assessment as to the best way to go, foreign tax credit claim or foreign earned income exclusion. You're absolutely right, Brian.
Absolutely. Brilliant. Yeah. Martin, what are our limits for so the question is the basic amount $2,880 for pension contributions for low earners also safe for US citizen residents in the UK, included in junior SIPs? Can you go into junior SIPs at all?
Yeah, well, to the best of my knowledge, you can have those gross contributions of 4,000. On the taxation, and just something that Gillian was discussing, which reminded me of something else, and it's probably the benefit of collaborating as we do when it's a US person, for example, resident in the UK. But yes, you can actually have, you can fund pensions indeed for spouse, or otherwise. On the taxation side, from the US point of view, of that I'm not entirely sure. But maybe that's one that Gillian might be better placed.
And the short answer is, again, yes, that's fine. You wouldn't get tax relief on those contributions because they are for another individual, in this case, the child, but there's no reason not to.
Brilliant. This next question, I think, is spot on. What are the options for an American self-employed in the UK?
Yeah, with regards to setting up pensions, quite a few actually. Yeah, I think, as we mentioned briefly earlier, personal pension or a SIP, again, driven by their circumstances, what their objectives are. Is it purely tradable securities they're looking to hold there, or they're looking to maybe have commercial real estate in determining which one? But yeah, they've good options, I would say, in short.
And so I didn't the second half of that question purely because Gillian answered it earlier. So it sounds like you just need to drop an email to Gillian to get her analysis on why she wouldn't consider it a PFIC, et cetera, so that you don't go through those hassles.
Yeah, couldn't agree more, Brian. I wouldn't necessarily agree with the understanding that's been indicated in the question. I completely get the foreign tax, foreign trust issue, and we've touched on that previously. I think more and more advisors are getting comfortable with 3520s and 3520A. Foreign trust reports aren't needed for any form of personal pension in the UK, whether you're self-employed or employed, just wanting a bit more say over your investment strategy in the pension. I'm not quite sure where it was coming from that these would be that there's passive foreign investment company PFIC issues, which is rules in the US, just very briefly, rules in the US where there's penal tax attached to profits made on investments that are considered bad investments from a US tax perspective. But as I've said, the way the double taxation agreement works, it's clear you don't look at what's within the pension from a taxing point of view. So the PFIC rules do not apply to anything within a recognised UK pension wrapper. Again, what whether the person's employed, self-employed, or whatever their status is. The issue of foreign trust is simply one of reporting, not one of taxation itself. So happy to sort of clarify any remaining questions offline.
Brilliant. I'm going to actually go back to that question as well. Martin reflected on it perfectly for somebody that's going to be here for a period of time and building a pension scheme. But let's just say you're here for a year and you're self-employed, and then you're going to be back in the States or be in another territory. There is a ruling in the States that allows you to set up a retirement account, i.e. a solo 401k or a simple or a SEP for yourself if you don't have a foreign pension in the country that you're resident. So you do have that option. It's going to be dependent on how long or how cumbersome it is to build the strategy in those types of ways, and that can be adapted based on those different lights. Now James comes in. This is kind of doubling down on our old question earlier with the credits, but I think it comes in a little bit easier terminology. Is it a good strategy to pay the tax on pension contributions on my U.S. return, lowering taxes on my distributions? Gillian, this is yours.
Oh, I know. The short answer is yes, it absolutely can be. And the reason why you'd want to consider it is, as Brian's already helped me out here by alluding to, which is one of foreign tax credit availability. So the bottom line is, if you're paying enough UK tax that even by not claiming tax relief on your pension contributions, you still don't have a US tax bill because you have got enough foreign tax credits, then you would absolutely want to consider it, because then when the pension comes out, and you may be back in the States and not have foreign tax credits available to you or accumulating, you've got what they call basis, and therefore the taxable amount when you start drawing the pension is much less from a US point of view. So it is definitely something that everyone should sort of just check in with their US tax advisor on, and their US tax advisor should be, UK US tax advisor should be saying to them, okay, we're going to put this through as a tax deduction on your return, or no, actually in your case it's going to be better to claim basis and report it now rather than claiming a tax deduction, because it will benefit you later down the line. You can't almost come up with a wholesale yes or no. It's unfortunately, like many things in the tax world, very fact and circumstances dependent, and no, that's not a cop-out on my side.
No, it's perfect because it's complex and it takes some planning. But doing that little bit of planning is going to save from heartache later on down the road. And typically people call us when it's too late instead of early on. You know, and an ounce of prevention is worth a pound of cure, as they say, if I go into the trite old sayings. We have another question coming in. It's my understanding that the lifetime ISA might look a little like a pension for non-US persons, but it is very much not covered by the tax treaty as a pension. Presumably, even the government bonus would be US taxable, and there would be no protection for PFICs, tax on ongoing income, gains, etc. So I'll let you start, Gillian. And
again, yes, that is pretty much a spot on analysis. No ISA is considered tax advantage from a US tax perspective. Cash, stocks and shares, lifetime, junior, none of them, unfortunately. So yes, you pretend the ISA wrapper isn't there, you look at the underlying investments as if they were held by the person directly from a US tax point of view. So it's absolutely right, you need to make sure that the investments in any ISA are compliant from a US point of view. And yes, it certainly would appear to be the case that, though I don't know that anyone's actually categorically asked the IRS this question, maybe we should, that the bonus would be taxable as well.
So I'll dig down into that a little bit deeper. Not only do we have to make sure that everything is IRS approved, so that means we need to make sure that we don't have any PFICs in there, because otherwise we're solving a tax problem here in the UK to cause a bigger one over in the United States. But the FCA will not allow any vehicles inside of there that are essentially aggregated from a foreign jurisdiction. So that leaves us as Americans in the position that we can only have cash ISAs or ISAs that have only individual stocks. So we offer some of these individual stock ISAs for individuals, but it doesn't solve the whole situation because, like Gillian said, we're avoiding the tax in the UK, but that means we get hit with the tax in the US. So for some individuals, that means that it's lower than the 20% tax that you would pay on your typical investments, but we don't get the same level of diversification that we'd be able to select from managed products like exchange traded funds and the likes. We're left with an individual stock ISA. So it isn't a one size fits all. It ends up becoming almost the opposite of what we would advise for your typical non-American here in the UK, which would be start by contributing your £20,000 a year to your ISA, well, £4,000 over to your lifetime ISA, and then start using other vehicles. Instead, we're basically saying, well, this is a tool that we can use to build around for a high net worth individual where the lack of diversification for that piece in the ISA doesn't become detrimental to the long-term plan.
And someone's very helpfully just asked the question that I get asked a lot, which is, okay, it sounds like ISAs aren't great. And certainly that's not the impression I want to give, because they categorically can have a valuable place in an overall investment strategy. Where, from a pure tax perspective, we see them work best is where someone's an additional higher rate or additional taxpayer. And the reason for that is, taking Brian's point that you're talking about single stock investments, you've got a situation where perhaps outside of an ISA, you'd be paying 32.5 or 38.1% UK tax on the dividend income being generated by those investments. But in the US, we've got access to the qualified dividend rate. And the qualified dividend rate is a maximum currently, and let's not even go there. The qualified dividend rate is currently 20% tops. So for those who are paying 38.1% here, you're cutting the tax bill still, the global tax bill on the dividend income within the ISA in half.
That's number 3 that she made everybody smile on this call. Martin,
I was always going for the hat trick, Brian. Come on.
I love it, and even the hockey reference in there. You know, I could be mean and come back and say, but what happens if the Biden tax initiatives go into effect? But I think we could spend an entire hour on that right now, and I think we can wait for that. UK premium bonds. Does any winnings get shown as interest on US tax returns?
You know what? I'm going to need to, you've got me. I'm going to need to double check on that one, because I cannot recall, I'm afraid. So, Michael, I will find out the answer, and via Brian or some mechanism, I will double check the answer and get that back to you.
Brilliant. Well, believe it or not, I think we've covered all of the different questions. I think the main takeaways that we've really taken from this is that, first of all, from inside, we need to make sure that we're not afraid of using these types of vehicles, and that we're using them in the best way possible, both contribution-wise and distribution-wise, from beginning to end, because we don't have that ability to build up an ultimately large size pension without penalties, but also we can catch up if we haven't done so in the past years. From Gillian's side, well, we have one of the best double taxation treaties in the world. I think Canada is the only one that has one that's similar to ours. So we shouldn't be scared away from these functions. We should take them in light and make sure that we make all the taxes work together. So can I hold UK Reits inside of an ISA is one extra conversation right there at the end. The answer to that would be that it would probably be considered a PFIC if it's in the format that I would have typically seen.
Yeah, I would agree with that.
Are distributions from a SIP UK pensions taxable in the US for a UK resident US citizen?
Reportable, yes, but offset, any US liability is offset by the UK tax paid on that income stream.
Brilliant. We got those last minute questions in. Martin, Gillian, thank you so much for being a part of this today. Everybody, we really appreciate you joining us. We will send you a recording of this just in case there's anything that you missed. I know Gillian and Martin both covered a lot of information. It will also include all of their contact information. So please, with any questions, do contact them or contact us. I want to wish you all a wonderful day. Thank you so much. Talk to you soon, okay?
Thanks, everybody.